How do child care credit and FSA compare for tax savings? Imagine saving money on child care costs without changing your daily routine. That's what understanding the difference between the child care tax credit and a dependent care flexible spending account can do for you. Both options help reduce your tax bill, but they work in different ways. The child care tax credit is a dollar-for-dollar reduction on your taxes. You can claim between 20% and 35% of your qualifying child care expenses, depending on your income. If your income is lower, you might get a higher percentage. You can claim up to $3,000 for one child or $6,000 for two or more children. This credit lowers the amount of tax you owe but doesn't reduce your taxable income directly. A dependent care flexible spending account is different. It's an account your employer sponsors, where you put pre-tax dollars, up to $5,000 a year for married couples filing jointly. These funds are used to pay for eligible child care expenses. Because you contribute before taxes, your taxable income drops, which means you pay less in federal income taxes, Social Security, and Medicare taxes. Some states also recognize these contributions, giving you extra savings. But remember, you have to use the money within the plan year, or you lose it. Also, the expenses must be for child care while you are working or looking for work. Comparing the two, the child care tax credit directly cuts your tax bill, while the FSA lowers your taxable income. If your family earns less than about $30,000 a year, the credit might give you more benefit because the percentage is higher for lower incomes. For families earning above $125,000, an FSA might save more money because it reduces your income in higher tax brackets and cuts payroll taxes. The FSA has a set contribution limit of $5,000, which might go up to $7,500 after 2025. The child care tax credit limits your claim to $3,000 for one child or $6,000 for multiple children. You can use both tools, but not for the same expenses. For example, if you put the maximum into your FSA, you can still claim the child care tax credit for additional expenses beyond what the FSA covers. Planning carefully is key. If your employer offers a dependent care FSA, contributing the maximum can cut your taxes and payroll taxes, especially if you are in a higher tax bracket. For families with lower or moderate incomes, the child care tax credit might give more immediate relief, especially since the percentage is higher for lower incomes. Keeping good records of your child care expenses is important to make sure they qualify and to avoid losing unused FSA funds at the end of the year. Talking to a tax professional can help you decide the best approach based on your income and child care costs. In the end, both the child care tax credit and the dependent care flexible spending account are useful tools for saving on child care costs. Knowing how they differ and how to use them together can help families maximize their tax savings while managing the expense of child care.